to the Capital Discussions Roundtable. I'm Tom Neagoy with our guest from Theta Trend, Dan. Jim Riggio is joining us shortly on the audio broadcast, but before we get started, quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. You don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And just to reinforce that this is for educational purposes only. So with that, I'll turn the presenter over to Dan, our guest today. And the first time Dan's been on the roundtable, so welcome, Dan. People really don't know about you much, I think, in our community, so maybe a little introduction would be great before you started.
Okay, sure. Yeah, thanks, Tom, for having me. It's an honor to be here. I've sort of seen you guys around for a while, and so I do feel honored to be asked to come speak. And actually, I was going to jump into my background a little bit here in a slide, so maybe we'll go to there. I was also going to say the same disclaimer applied, and that's still here. So at any rate, I'm going to just go ahead and start this, if that's okay.
Yeah, you got to share your screen though.
Oh, okay. Or sharing is something that I need to do.
Yeah, if you're on Windows, you should be able to go Control-Alt-D, like Delta.
So I'm on Mac.
There's probably Command something. There's a menu
option.
On the top, there's a menu that says Share.
On the top, there's a menu that says Share.
Also, the Quick Start tab should have it.
There it is. Okay, I found the Quick Start tab.
There we go.
Are we all on board here?
Yep, we can see it.
Okay, great. Hi, Jim.
How you doing?
Okay, so I was going to talk just sort of briefly about my background. I'm a little bit younger, I think, than some of the options income traders you see out there. And so my foray into trading sort of started back in the late 90s when I was in high school. And at that time, I was trying to day trade with dial-up modem from western Nebraska, if you can believe it or not. And that was relatively short-lived and unsuccessful. I think I lost a few $100s or something like that. My dad could probably tell you exactly how much because I think it was his money, surely. And at that time, I was also kind of reading about options, and it was a lot of the kind of those basic Macmillan books back then. That's what was out. And then after that, sort of there's like a window of time from 99 to 2008 where I was in college and I wasn't real involved with the markets. But I was kind of reading the financial news. I was aware of what was going on. I was reading a lot of Richard Russell's writing for the investors out there who are familiar with him, the Dow Theory letters stuff. And I sort of always liked how Richard's written, which is in like a very conversational way and relatable way. And I think that a lot of what I do on the Theta Trend is sort of inspired by that characteristic of this is sort of a personal thing too, And so I went to grad school in 2008 for accounting. That was a questionable decision for me, I guess. But while I was there, they had this program called the Barker Capital Management and Trading Program. And this is at the University of Idaho, up in northern Idaho. And what the program really was is there was this alumni by the name of Rachi Barker. And Rachi had graduated also in accounting, I think, unfortunately, and gone to trade on, I think, the Chicago Mercantile Exchange, something like that. He went to Chicago and traded, and he was a commodities futures trader, and he was doing, I guess, a lot of spread trading of, the crack spread and things like that. I'm not super familiar with it, but something like that. And so he's older, and he decided to give this money to the school, and he said, here's this money as a donation, but I want the kids to be able to actively trade this money, and I want there to be coursework about trading options and futures and derivatives and things like that. So the program was pretty cool, and that was kind of when I got really heavily back into the markets, I guess you would say. And I spent probably the majority of my time in graduate school watching the markets during class and trying to do as little accounting as possible. I was never exceptionally committed to the practice of accounting, I guess. But over the years, I traded a lot of different strategies, sort of listed here, trend following strategies, and those are outright mechanical systems, non-directional and directional options strategies, but always positive beta. So I've never been a buyer of options. And I think that I have a general tendency to prefer lower gamma. And I know that because I've traded some weekly options and lost a pile of money and found it to be very stressful. So, and I also tried scalping futures in Forex, which, I describe as paying the rent for toss, because I don't think I made any money. I don't think I lost a ton of money, but I certainly spent a lot on commissions. And Thinkorswim has always been my preferred broker, so that's why I say paying the rent for toss. Let's see here. So in 2008, this is kind of jumping back there, I started trading iron condors. And I had the experience early on when implied volatility was very, very high that trading iron condors was relatively easy. So I felt like something of a genius. And then when, we came into 2009, and everybody knows, and, I think April of 2009, the market made a bottom, and it started this relentless rally that went on for some time. And I would say that for the majority of that rally, I was sort of short delta and generally getting blown out on the upside. And what kind of happened is my iron condors went through this evolution where I was trading higher delta iron condors with a better expiration risk reward. And I slowly moved into higher probability, selling 10 deltas and things like that a little bit further out in time. But I was constantly getting into trouble on the upside, on the call side. And so somewhere in there, I started trading butterflies. And I liked the butterfly because I could adjust the trade and, move it around without getting into an adverse situation, I guess, at least not as quickly. And so the CIB is sort of the product of that progression. Trading is something of a progression, and it always is adjusting and adapting, moving forward, and sort of about learning from mistakes and things like that. So these are some of the goals for the CIB trade, to win as often as possible while taking responsible risk and minimal heat. So basically, I don't like to bet the farm. I don't sleep well when I have a lot of risk on. It makes me uncomfortable. And I think that controlling risk and being aware of risk is very important. And I think some of that probably comes from the trend following strategies where you're constantly losing. Also you want to trap the market long enough to collect a little bit of premium, but I don't really like sitting in trades. And so my goal is always to sort of get a little bit of money and get out of it, because I worry that the market's going to continue moving or change its mind or change directions. And I'm not a big fan once I'm up money of sitting around and, waiting to see what happens. This provide an opportunity for larger wins sort of applies to the trade, which has a couple different stages of it. We'll see that in some of the images here shortly. But as the trade grows, there is the opportunity for larger wins, and this is something that I'm working on, is controlling the trade as it comes in closer to expiration. And the trade I called the core income butterfly. Tom, you called it the conservative income butterfly, which I sort of prefer and which I would have thought of at the time. But, the core, just because it's sort of something that can be put on every month, which is the purpose of an options income trade clearly. And then I can be experimenting and trading other strategies around it. And I do have the affliction. I'm always experimenting with something new. And lastly, I wanted to have some opportunity for discretion. And I guess what I mean by that is that I had traded a lot of trend following strategies, and they were rules based, but I did have opinions about the market. I always have an opinion about the market. And so I wanted the opportunity to sort of put my opinion into action, to trade that opinion to some extent. And these are some philosophies that underlie the trade. So we should always be learning. And we're going to look also at historical context to sort of see how the trade came about. The upside can be as risky as the downside. I've certainly had more trouble on the upside than on the downside. And at the same time, generally the market moves up more measured, and it does have some pullbacks. But on the downside, it sort of has two speeds, I think. It has fast, really fast, and then it also likes to do the thing where it goes down really fast and then comes flying back up, especially, in the past few years we've seen that. I think about price, this is sort of similar to some of the market profile things that you see out there. I think about price as having a mean. And so what I'm sort of trying to do is follow the market around and create this little pocket of decay, and then wait for it to slow down, somewhere around the mean, or revert to that mean, which is ideally lower. And, it comes back to this idea of having like areas of consolidation, or the market profile guys would call this value, so the market has a value area, and that's sort of like a range of prices where the market's trading. And if you look at a distribution of prices, what you see is you sort of see prices trade out to those tails. They don't really like it there, and they kind of come back into, the center distribution. And then at some point, as price moves to the outside of that distribution, it tends to push up and out and maybe move to a new area of value or a new distribution. And that also brings us back to the idea that the mean price or the average price is not a static thing. And we know that because we see the moving averages moving, right? I mean, that's, if you think about like the 50-day moving average, for example, we see the things going either up or it's going down. So price might revert to that mean, but the mean may be higher when it reverts, if that makes sense. So this is what the CIB looks like in general, and I think that people in your community are going to recognize this as looking very similar to an M3, John Locke's M3. And I have studied what John has done through his free material and things like that. I haven't actually paid to take his course, but his work is exceptional, and I think that the sheer fact that none of us can talk about a butterfly without making reference to John Locke is, I guess, something of a testament to the work he's done in the space. But at any rate, this is what the CIB looks like at initiation. I'm generally setting up, I would say, 10 to 15 points below the money personally. And the reason I do that is that I feel like I'm constantly wrong on direction. And so I try to be a little bit closer to the money if possible. And I'm adding a long call. And we'll come back to some of these entry criteria and rules and stuff as we go along. This is what the position looks like. It says after 2 adjustments, but there's actually a third in here as well. So what I've done is I've added a second butterfly, and then can you see my cursor here?
Yep, sure can.
Okay, so it looks like the lower butterfly has a rolled up long put there. This is what the position looks like after 3 adjustments in a pretty basic sense. And, this is, the T+0 line is still pretty flat. There's not a lot of risk in either direction. And the real benefit is, if the market comes back down on us a little bit. So this is what I was talking about. This is sort of to create some historical context to the trade. When I started trading butterflies, I was trading things that were looking like this, right? Something positioned relatively close to the money and, a little ways out in time. And then I would add to the positions using both balanced butterflies and also broken wing butterflies. And so I would end up sort of in like a lumpy condor kind of thing that moved up, and then, you're basically adding risk to this position as the market moves up and against me. And it was kind of at this point in my trading where I came across what some of you guys were doing and what John Locke was doing, and I said, well, we could still add to this position, but, mitigating some of that upside risk is a really good idea via a long call. So these are the trade entry conditions, or the criteria, I guess, that I look for when I'm putting on the trade. 40 to 60 days to expiration. I sort of lean on the longer side of that, 55 to 65. I opened one up, I think it was yesterday morning, and that's 63-ish days, something like that. So that's pretty typical for me. Generally, I try to be out of the thing somewhere in that 25 to 35-day range. And I've had the realization that as we get inside of that 30-day range, the trade gets faster, gamma starts to pick up, the T+0 line becomes not necessarily more challenging to control, but it requires more maintenance, more monitoring, and things like that. I think the people in your community who've traded shorter dated butterflies probably recognize that and, know what I mean. In general, I look for a short-term overbought conditions in the market to get involved in the trade. And if we were to scroll back, the reason is simply that there's going to be more room on the downside. We're going to have a little bit, you kind of have like a safer spot there on the downside. If the market's overbought and it comes down a little bit on you, that's okay. What I don't really care for is when I put on a position and then the thing goes blasting out the top of the tent, as you might see. And one of the things that I've struggled with butterflies is trying to identify, what's the appropriate width for a butterfly? What's the appropriate strike width? And what I've sort of settled on is this idea that you can have, if you look at it in terms of risk reward, somewhere in the neighborhood of 25 to 33%. So in the case of like a 50-point wide rut butterfly, that's, so if the strikes are 50 points wide, our risk on that position is $4,000, and we're going to pay $10 to enter the butterfly, say. So that gives us a 1 to 4, 25%. The upper side of that is about 12.5, gives you 33%. So that's sort of the neighborhood of the prices that I'm looking at for this. And obviously that changes. If you go further out of the money, if you put the butterfly a little bit lower, it's gonna cost you less money. As you get closer to expiration, it's gonna cost you more money. If implied volatility is higher, obviously you're gonna pay less for the butterfly, all things being equal. And so I set up the trade using an out of the money long call. And I call this the John Locke question because I receive this email all the time, which is, why are you using an out of the money long call to hedge the position? And the explanation is really simple. I mean, it's just that's the amount of delta I need to flatten out the T+0 line. I do tend to be bearish. I always describe myself as a perma bear, so I'm more comfortable putting on that slightly out of the money option. And I know in some months it's going to decay. And then if the market moves up, it's going to be more of a challenge, but it's sort of, it's just a trade-off. Everything's a trade-off, and that's what I'm comfortable with. If the market does move up, I usually roll up one of the short puts or something, and that, kind of brings it back under control. The Greeks at initiation are, positive delta, very little gamma, positive theta. Oh, sorry, did I say positive delta? It's 0 to slightly short delta and positive theta. So obviously we have two directions that we need to adjust the trade. You adjust it on the upside and you adjust it on the downside. On the upside, I'm going to add to the position up to 2 times and then begin rolling it higher. But one of the things I would say about this, and we'll take a look at a sample trade, is that I don't follow this religiously. In some cases, I add a broken wing butterfly. In some cases, I split the short strikes. In some cases, I'll roll the, I'll add one butterfly and then I'll roll the lower one up instead of adding a third. And really what that has to do with is sort of my opinion of the market and what I think is going on. There are some recommendations within the course of the trade, but I don't personally always follow them exactly to the T. On the downside, we're just going to be rolling the position lower. And I don't like to add on the downside because I don't know where the market's going to go, and I don't like to take on additional risk. It's just not my personal preference, I guess. This scenario here, what if nothing really happens? This is kind of the situation where you're sitting in the trade and the market hangs around, and then, suddenly 2 weeks pass and all of a sudden it decides to go higher on you. That's the case where that long call is going to have decayed and you run into a little bit of an issue there. And, usually what I do there is roll up one of the short puts and just to pick up a little bit of delta. On the trade, I target $300 both as a risk reward. And the reason for that is that it's pretty easy to hit that, in my experience. In most months, I'm going to hit that, and that's kind of my goal. Is I wanted something that won as often as possible, I guess. And at the same time, I didn't want to take a huge loss because I'm just not a fan of, seeing my account shrink by 7 to 10% in a month. I just don't feel comfortable with that personally. And this last point here it kind of underlies a lot of the adjustment philosophies in general, and that's simply, what are you trying to accomplish and what's creating the issue? So when you start adding butterflies on top of butterflies, as you get later into the trade, those butterflies are going to have slightly shorter delta. They're going to be shorter delta even with a long call. And so I think it's important to be aware of what we're doing and to try to understand how the adjustment's actually changing the position, both in the T+0 line and also, from an absolute risk standpoint. One of the things I don't feel comfortable with is kind of that, out of the money vertical spread looking trade where you have a whole bunch of risk sitting down there. I realize that, probably the market's not going to go down there, but it's one of the things that I don't personally care for. So these are some of the specifics on the upside adjustments. I'm essentially adjusting the position when price leaves the expiration tent, approximately. And this, again, is somewhat discretionary, but in general, when price starts getting a little bit beyond that expiration tent, I start saying, okay, well, clearly the market wants to go at least a little bit higher, so I'm going to go ahead and add to the position or roll the position, or I'm going to do something. Essentially, something needs to be done. So the options for adjustment at that point are, rolling up the initial trade, adding another butterfly with a long call, and I'll go in size up to 3 butterflies to do this. In some cases, adding a broken wing butterfly, and I'll put that on, maybe a little bit closer to the money just to stretch out that tent. So I might do this in a situation, in the sample trade we'll look at, I think I added a broken wing butterfly. I might do that in a situation where the market's trying to push higher, like say into a Fed announcement or something, but I don't believe it. And so I might put on something like that just to give myself a little bit of extra room and hopefully not, let the market get too far beyond me, but maybe I don't really think it's going to stay up there. And rolling up short puts is something I do when the trade, when the trade's getting a little bit too short delta and we're still inside of the 10. So sort of when that T+0 line starts diving with inside of the 10, I guess is how I would describe that. And then these are the recommended steps for making an adjustment, which are basically to add another butterfly with long call 1 or 2 times. And depending on the size of your account, maybe you only feel comfortable doing that 2 times. I've traded this trade with small capital. I know that some of the members of your community are trading more capital, so it's all relative. And then after getting to that 3rd butterfly, then I really start rolling it. and I will not continue to add anymore. There was a time, we go back to that historical trade where I had that lumpy condor. In those cases, I was getting numerous butterflies added onto there. 4 or 5 butterflies was not unusual. But now I think that, kind of staying around 3 is a little bit more manageable, because as you start getting really high, those lower butterflies are really not doing you any good anymore. So on the downside, this is stuff that is probably obvious to all of us. When the market goes down, it goes down fast, usually. And, when implied volatility pops, it can actually help the trade depending on how the, implied volatility of all the individual options move. Usually you see the skew steepen, and in many cases these trades look a little bit better after the market sells off and implied volatility comes up. The only adjustment I make on the downside, again, is to roll the position lower. And I do that when price trades down to about 20 points or so above that lower long put. And then I put it back on either at the money or slightly lower. I would say in general I put it on at the money or 10 points below, something like that. 15 maybe if I'm really bearish. And the other situation here is what happens if you have multiple butterflies on, and you say we were in that 2 butterfly position, the market has traded higher, and then it starts selling off. The way that I look at the trade is I kind of look at each butterfly individually, and by that I mean each butterfly in long call. And what I'll do is I'll take off the upper butterfly only, for example, if price is trading closer down to the long put for the upper butterfly, and I'll leave the lower butterfly on and let the market continue lower if it wants, or if it comes back up, I can always add back on that upper position. And one of the things to ask, is when you do that, when you start taking off these butterflies, how much of a profit are you going to be locking in? Because in some cases you do, I would say actually in most cases, if you put on a butterfly, since the things are sort of short delta and the market trades lower, you're probably going to be locking in a profit. And one of the other exit rules that I use, I'm not sure that we talked about it before, is I have what I call like a quick exit rule. So if the trade's up $150 within the first 2 weeks or so, say, something like that, a relatively short time after entering it, I'll just close the position and say, that was a quick, fast profit. Maybe I'll just take that and wait around and be out of the market. And again, that's sort of an optional thing that you could choose to do, or you could maybe say, nah, I don't want to do that. Tom, are there any questions up to this point?
Not yet.
Okay, thanks. I needed a drink of water there. One other thing I wanted to say, and I realized that, I'll get you here in just a second, Ron. One of the things I wanted to say about the rolling process is when I roll up the butterflies, I'll keep the initial long call that I had. I'm not going to be closing out the butterfly and the call. I'm going to keep that original call, if that makes sense. Ron, your question about the planned capital for the trade, it's in general, at the peak of a trade, I'll get up to somewhere in the neighborhood of 5,000 to 6,000, something like that, in total risk. And usually it's less than that. In all honesty, I prefer to keep the trade kind of at the 2 butterfly stage and only go into 3 butterflies for a relatively short period of time and then take it off. And that, again, is just personal preference. I'm a pretty risk-averse guy, and I just feel more comfortable when I have less risk on. So this is another adjusting to control risk. Jay says, I think I missed Jay's question there.
Oh, he just put it in there.
Do you get an alert when you put a position every month? I'm not sure. I mean, I get an email from Toss that says my trade's been filled. And usually after I put on an initial position, what I do is I go in and I set alerts for the trade at certain price levels. So if I know that, let's suppose that the rut's going to get outside of the tent at somewhere around 1170 or something, I usually put an alert maybe 1165, just so I know that the market's getting close to getting me into trouble or getting me to a point where I need to do something. And I get emails from them.
Yeah, I think you might be asking if you have like an alert service. So like when you put a new trade on, do you send out a notice to your subscribers?
You know, I don't have an alert service. I try my best to tweet it out, but also keep in mind that I'm at work at the moment, so it's sort of like I'm trying to get these orders filled, and then I'm, you know, hovered over my phone at my desk trying to tweet them out. So it's something that I'm not able to do real time in all cases, but I generally let people know people will find out on the blog within a few days if they don't follow me on Twitter, because I'll mention it in the weekend commentary on there. At Theta Trend is my Twitter handle. Okay, so sure thing. So adjusting control risk. This is something that I just try to be aware of. So we know that the market has an amount that it sort of tends to move every day. And that depends kind of on the environment that we're in. And so a lot of people have come up to this, you know, or have come up with this idea of looking at price movements in terms of standard deviations. You could also look at this in terms of average true range. The idea is that I like to have a sense for how much the Russell is moving at any given point in time. So one of the things I compute when I go into a trade is the one-day, one standard deviation move, just so I have a sense of, you know, roughly how much the Russell might move. You know, so say right now it's 15-ish points. I don't know exactly what it is, but say it's 15-ish points. So I look at my positions and I think about them in terms of where I am if I'm drawing down money relative to where one standard deviation or an average true range move is going to take the market. And if I'm getting close to hitting that maximum loss level, so if I have an open loss around $300 or something, I know that I have a problem and probably I need to do something about it. So I just use this kind of as oh, perfect. Thanks, Ron. I just use this kind of as a way of monitoring my positions and saying, you know, am I in trouble or in danger of getting in trouble? And since the T+0 line of this trade is relatively flat, usually it's going to be okay. But it's just something that I like to keep an eye on and be aware of. And I think we always have to think think about the position not just in terms of where the market is today, where the market closed, but where the market might go and what's going to happen to you if the market goes there. So that's just something to kind of keep in mind, I guess. And generally, as you can see here, you know, this is the type of thing that I'm more concerned with on the upside of the trade than the downside of the trade. You know, so if the market comes down, usually it's $300 is the max loss. So if the market comes down, usually I can get out of the position without getting myself into trouble. It's more the situation where the market is relentlessly marching higher that I'm going to be running into this problem. If at any point in the trade the trade becomes long delta, I know I definitely have a problem. So everybody's probably familiar, you know, in a basic sense with the Greeks. And I don't religiously follow specific Greeks. I kind of rely heavily on the risk graph itself, and I look at positions just to say, does this look like a reasonable position to be in? Am I in danger of getting in trouble? I mean, it's those kinds of things. But just, you know, for reference, when the trade starts, it's usually starting slightly short delta. You know, I would say -1 to -2. And this is again for the size of one rut butterfly with one IWM call. You know, so you can multiply that out to whatever the appropriate size for your position is. Yeah, and again here, positive delta is definitely reason for concern because normally what positive delta means in the context of this trade is that the market has sold off heavily and we're outside of the tent on the downside, which is somewhere that I don't really want to be. Gamma, when the trade is opened, is very close to zero, so there's not a ton of risk there. And again, we talked about this as you get inside of 30 days. The Greeks tend to change. So earlier in the trade, let's call it like the 60 to 30 days to expiration window. The Greeks are relatively easy to control, and the position a lot of the time kind of keeps them in line themselves. As you get inside of that 30-day window, and maybe even inside of 40 days, we could go out to there, they start to change more quickly, and the position starts to move more. The T+0 line becomes more difficult to manage. And my preference is not to, not to be around for that stage of the trade and to be out somewhere in there. So these are some final thoughts on adjustments. Understand why you're trying to make an adjustment. A lot of the time, people think about adjustments and they think, oh, I have to adjust this trade. I need to make this adjustment because price moved to here or whatever. I don't necessarily believe in mechanically following adjustments. I kind of believe in looking at the position, understanding where the market is, what the market might do, and making adjustments based on all of those things. So it's less static. It's not totally rules-based, I guess is what you would say. And I think that's the danger in blindly following adjustments in Greeks. And I know that there's a lot to be said for trading with a plan and having rules and all of those sorts of things, but I do trade this position with a fair amount of discretion. And this concept of not waiting too long, but not over adjusting is kind of this is the gray area, it's kind of this is the purple unicorn. It's kind of like, when do you find it, But you do have to be careful that you don't want to let the risk get way out of control or you get drawn down too much. But at the same time, you don't want to be sitting there all day long thinking, oh, I need to adjust this position, I need to adjust this position. And this is the kind of thing that I think you get a feel for over time. I don't think that there's a way to, say it's at X, for example. I do rely heavily on the risk graph for all decision making. I'm basically looking at the expiration risk graph for the position and also the T+0 line just to see where I am. I know that some people like to day step the T+0 line, and it's something that I guess I don't really do. I sort of look at it sometimes, but one of the things that seems weird, and I don't know, maybe it's just me, it seems like those day steps are theoretical, and I feel like the positions don't always trade in the way that you would expect them to when you do the day steps, at least in Thinkorswim. It's not always the case. So I kind of look at it, but I don't base decisions on them. And this evaluate your risk based on what could happen comes back to that standard deviation calculation and knowing where the market could go tomorrow or, might go in the future and things like that. I'm very quick to admit that I'm wrong in a position. I have no trouble saying, because being a perma bear when stocks go up all the time, it's very easy to be wrong. I mean, I get opportunities to be wrong all the time. So it's kind of that mentality that I'll put on a bearish trade, the market will be at a low, which seems to be like my life story. And then, the thing goes racing higher. So when I know I'm wrong, I just, move the thing. It's not a matter of trying to make it right. It's just starting over. This is another thing that is kind of important for adjustments about identifying what you want the resulting position to look like. I think about adjustments in both as, having options. I think I missed that question from Cheryl. You have different things that you can do to achieve different outcomes. But one of the things we don't always think about, I think, is sort of what do we want this position to look like when we're done adjusting it? What characteristics do we want it to have? And both along the T+0 line and also at expiration. And so that's something you kind of think about when you're making adjustments is, say I could have this position look exactly the way I wanted to. Okay, we all know that that's probably the T+0 line above the 0 line at all times. But, short of that, what could we make this look like to, create the outcome we want? And then how can we build that? Do we want to circle back to that last question? I think I missed it. It was something about individual implied volatilities.
Yeah, do you use individual implied volatility model in TOS to manage the trade or volatility smile?
No, not really. I do track the individual implied volatilities of my options. So when I get into a trade, I put all these things into as per Cheryl's question, I put all these things into a spreadsheet, and so I look at the individual implied volatilities of the options when I get into the position. But I would say that I don't obsess about it, and I don't spend a significant amount of time thinking about it in general. So these are some of the major exit rules. If you look at price movements in terms of that one standard deviation or one average to range, I meant the volatility model on TOS. Honestly, I'm not even sure what it defaults to. I think they're asking about the model. So they mean like Black-Scholes or?
Yeah, and TOS, and you go on the upper right to that gear, and then go, I think, display settings. And
I just use the default setting.
Okay.
Sure thing. So the major exit rules, keep an eye on that one standard deviation level at all times. And I think about that because, in some cases, if you can anticipate hitting your maximum loss, you can do something about it before you get there. Not in all cases, certainly, but sometimes you can. And if you can use that sort of as a warning sign, maybe you can stay in the trade and either lose less money or, have the potential to make money depending on how things shake out for you. I look at a max loss sort of in the $250 to $300 range. And one of the things that's important, especially with all of these complex option strategies, is keeping track of all of your adjustments because, the record-keeping process of this can really get away from you. I think you guys that are in option view maybe have an easier time with this. But for TOS users, it is kind of a little bit more of a manual process and slightly more tedious, I guess, to make sure you're not letting your open loss get away from you too much. The target profit is $300 again, and in general, I've been trying to let these trades run up over that $300 level just to pay for the cost of commissions. The 15% in 2 weeks rule is another optional adjustment, and that's that $150 within a couple of weeks. If you pick that up, then it might make sense to just get out of the position. Sorry, I missed that last question too. And of course, if you're ever uncomfortable with the size of this position, it makes sense to close it. And the reason I say that is because sometimes when it's up to that 3 butterfly size, I don't always feel real comfortable sitting in that trade because I'm getting pretty short delta usually. The market's been raging up. And so it's sort of like a last-ditch attempt to adjust the trade. And from there, I'm either going to close the lowest butterfly or I'm going to take off the upper butterfly if the market pulls back. But if at any time you're uncomfortable, I think it's not a bad idea to get out. So we'll scale out of the positions. Usually what I'm doing is, so say we go up to 3 butterflies in size, okay? What I'm hoping happens is the market pulls back. If the market pulls back, what I'm going to do is I'm going to take off that upper butterfly, and then I'll be left in this position that has 2 butterflies, 2 calls, sometimes 3 calls, depending on how things have worked out. And I'm going to have a pretty flat T+0 line that's floating above 0 because I've locked in some profit on that upper butterfly. And from there, generally, if you take off that upper butterfly, you're very close to that 300-ish range, and you're going to be taking off the rest of the position pretty soon. In general, if you get into one of those, it's happening a little ways into the trade, and then you're going to be taking some money off the table when you close it out.
Hey, Dan, Kevin had a question. What percentage of your max risk is a $300 profit?
Well, so the max risk in it varies. So I guess that's, suppose we went up to, it's 6% on $5,000.
Okay.
And there's a slide a little bit later on here that actually goes through some of those position sizing things. This case study might be kind of good to walk through because it will kind of illustrate some of these things. We haven't had any pictures really up to this point, and so it's difficult maybe to see what's going on, and we're thinking about this conceptually, but I think if we look at some pictures, some of this will make a little more sense. And then after that, there's a slide or two on, position sizing and things that probably answer some of those questions as well. So at any rate, so this is March 2015, the trade, and we'll look here. So this is a price chart of the Russell during the period of this trade. And so here's what was going on. The market was here, it's kind of chopping around. It does this big sell-off. This is probably the point at which I decide the BRUT is going to zero or something like that, which is what I always think is going to happen. And so I decide to enter a bearish trade because I think, the market's going to continue lower and I'm going to miss my chance, or I'm going to get worse location. So as frequently happens to me, what happens is the market does go a little bit lower and then it turns around and it goes flying higher. And sort of the sad thing about this particular position is that I took this trade off at the absolute worst time. So I took it off here on this big up day, and if I had sat in this, it would have been really nice. The price would have traded right down into the middle of the butterfly, and it would have been a great trade, assuming I got out before that. Thanks, Tom. So I picked a short-term low to enter a bearish trade. This is kind of par for the course for me. Price went from 1170 to 1240, which is about 5.9%. So not an enormous move, but a decent-sized move. The worst drawdown I had in this trade was about $125, which is not awful. And again, I chose the wrong time to exit the trade. The trade grossed about 254, 197. So this is the initial trade. You can see prices here at about 1190, and I'm not. Oh, I think this is the day of entry. I think I had entered on the low of the day, and the market traded higher on me right away, and so I go into the night down, $65 or something. The next adjustment was here. We added the 1180 fly. So we started out. This is the 1160, and I can't quite see my calls here because they're up above this rut, but the market obviously traded higher. Yeah, so the market got outside of the tent here. It looks like it's up at about 1208, so I added the 1180 fly, and I added some sort of another IWM call. I missed that question too. The next adjustment, what I did is I closed out the 1160 butterfly, which was originally down here. So let's go back here real fast. So we've got the 1160 butterfly, you can see that here, and we've got the 1180 right there. The market continues higher, so I decide to close out the 1160 and move that up, it looks like, to 1200 or so. So I'm at the 1180 and the 1200. And this is one of those situations, where we talk about, I don't always follow the rules religiously or to a T. Because I had decided at this point in the trade, I think that, well, clearly I was wrong on the direction. The market is not going lower. So rather than putting myself into a position where I have 3 butterflies and a lot of size on, I'm just going to go ahead and move up that lowest one because it'll give me more room here, more room to run up here. And I'm not going to be creating a drag on the trade, with a bunch of negative delta as the market continues higher. I have more fear about the market going up than going down most of the time. So the market does continue higher, and I end up adding the 1220. And in this case, I added a 50 by 40 broken wing butterfly as opposed to a balanced 50 point, by 50 point butterfly. And some of that probably had to do with trying to keep the delta a little bit flatter. So you can see here in this position that, the delta is starting to come off a little bit. The T+0 line is diving within the body of the butterfly. And this is a situation in general that I'm not crazy about. And at the same time, though, I know that the market's come from down here and it's all the way up here now. So at this point in the trade, I'm usually becoming slightly more comfortable leaning a little bit of short delta. But it's not black and white. It is a little bit subjective. So I think what we had happen here, so we're in this position. We have the 1220, 1200, the 1180, and it looks like the market's at 1227, which is right here. I think what happened is immediately after adding this, the market traded lower. It sold off. And so what I did is it's sort of like I guess you call it like a partial reverse Harvey. So instead of knocking in the long puts on both sides, I just did it on the upside. And this was more of an effort to flatten this out just in case we do get another real push higher. I'm relatively comfortable sitting in the trade with the market hovering right around here, right around this expiration break-even point. I don't worry too much. It's sort of like out here that I start to say we need to do something about this trade. So I think this was a situation where the market did trade lower, and what I chose to do was to close out that 1180 butterfly, which was down here. With the market way up here in that 1230-ish area, we're beyond the long put of that lower butterfly, and it's really not doing us a whole bunch of good. So if I get the opportunity to close out a butterfly, I'll sometimes do that on, a down day if I want to keep the trade running for a little bit longer, and that's what I chose to do here. This is the trade right before it closed out. The T+0 line is starting to, this is the situation as you get closer to expiration, you start to have this kind of thing happen. And certainly could have rolled up some puts, but it was getting close to the target profit. And I think after chasing the market higher from such a low level, I was just ready to get out of the thing, and there are months like that where I just don't want to deal with it and just want out. This is something that I, definitely recommend doing, which is tracking the Greeks for the positions on a daily basis. And one of the things that I look at here is, I can see kind of what my deltas were, and my deltas were getting high here, late in February. This is, maybe about 3 weeks into the trade or something like that, and the deltas are getting high. But the other thing that I think is sort of interesting is that the trade frequently is not, it doesn't make money until the very end, I guess, is what I would say. It kind of flops back and forth between a slight profit and no profit, or, it depends obviously what the market does, but in many cases I'll be drawn down money for a good portion of the life of the trade, but it's usually not a whole bunch of money. I guess it's a small amount, and then all of a sudden when it starts to make money, it's kind of like, a window of opportunity to take that money and close. So these are some observations I have from trading the position. Obviously, the trade's not going to be up money every day. Fast directional moves that go up late in the trade are challenging, and this is kind of the scenario where that long call decays on you, and the market goes racing higher in your short delta. That's just something that to be aware of, I guess. Pullbacks late in the trade are wonderful. That's like the best thing that can happen in most cases. And I'm looking at that $300 risk reward level. And, another thing to point out in regards to that is that $300 level is kind of something that I shoot for hitting. And I've just taken that one-to-one stance. But if somebody was trading this position and they were pulling more money out of the trade, it might make sense to have a slightly higher risk level. And at the same time, it's probably not all that necessary. So I don't know. It's just something to keep in mind. This risk-reward equation, this expected outcome, this is something that you see a lot in the trend following space. You know, the guys that build these mechanical systems, and they say the expected outcome is equal to the probability of winning times the average win minus the probability of losing times the average loss. So for an options income strategy, that's, expectancy, exactly. So, for an options income strategy, what we know is that we're going to have a really high probability of winning. It's not uncommon to say 75%, 80%, 90%, something like that. That's not uncommon. And the probability of losing then is obviously going to be very low. The thing that I think a lot about is, both how can you increase that average win and keep that average loss really small. Because with a lot of these strategies, like if we think about a vertical spread or something like that, if you were to take the maximum loss on that, that's a huge maximum loss. And so I think the appeal in trading butterflies is that you're able to create a position that has a much higher average win while keeping that average loss relatively low. And so I just think it has a better expectancy, better expected outcome, if you will. So this goes back to the position sizing question. Let me just get a drink of water real fast.
No problem.
I've been trading it so I was trading butterflies in 2014, sort of in that adding to them using broken wing butterflies and also balanced butterflies. I was doing that in 2014, and I've been trading this through 2015. I'm trading, so the position starts out as one rut butterfly with one IWM call. So I'm using IWM to hedge rut because I wanted this trade to be able to trade in a smaller account, say like $10,000, $7,500. So what percentage of equity at risk? The reason for these recommendations too, like this $10,000 account, 5 to 7,500, it's really based on this percentage of equity at risk. So losing $300 on a $10,000 account represents 3% of capital. And, there are a lot of tables that show you the returns that you need to make to overcome losses. And so really the long game of trading is kind of not losing too much money and being around to make money. And so I don't feel comfortable losing a large percentage of my capital on any one trade or in any one position. And so this $300 on $10,000 is just intended to be responsible risk taking more than anything else. And I realize that these things win more at the time, and theoretically you probably could take more risk, but this is just kind of my comfort level with it, and I think it's responsible. And if somebody's returning 3% a month or something, that's really a pretty respectable return. I think I missed that last question though. So these are some of the things that we've been talking about. The risk that we're taking on the downside in particular is similar to some of the index condors, but the difference, as is the case with a lot of butterflies, you have the opportunity for more yield. You can make more money on the thing than just the simple iron condor. And this 50-point wide butterfly is not, it's not as tiny as trading one of the ETF products and things like that. But it's not an enormous trade, and it's easy to manage it. A variation of the CIB is to only use, say, 2 butterflies with 2 on calls instead of going up to that full-size third butterfly. And the obvious challenge with trading this on ETFs is commission costs. I pay $1.50 a commission, which I think is probably more than a lot of you pay. But I'm able to overcome that. So I imagine if you pay less, it would be better. And I only trade this on index products. I've had a couple of people ask, about the trading it on single stocks and things like that, but that's just a game that I don't get into. I only trade this on the Russell using RUT and IWM. And one of the things that I've observed, but I haven't figured out a way to quantify this, is that it seems as though SPX, the S&P, trends better than the RUT. I don't know if that's true or not, but for some reason I just seem to consistently have fewer problems in the RUT than I do when I'm in SPX. And so I've tended to gravitate towards strategies in the RUT. Yeah, and NDX is something that I don't even. I try to stay away from things that trend, and the challenge is quantifying what constitutes a trend and, how much something trends, I guess. But one of the things about RUT is that it does make big moves, but it does also at the same time tend to come back on you and give you opportunities to get out or to adjust or close positions or peel off and do all of those things for what that's worth.
Did you see the question about do you adjust once a day or when the Greeks dictate?
Yeah, so here, this is an interesting point. So I'm a CPA, and I work as a tax accountant. And so one of the things that I'm experimenting with right now is only looking at this trade twice a day. In the past, what I've done is I've had alerts set up in Thinkorswim, and so I would get an email or whatever, and I would say, okay, I need to go in and make an adjustment, or as I mentioned before, I tend to put my alerts slightly ahead of my adjustment levels so that I know I'm going to be running into problems. But one of the things I'm trying to do is say, okay, I'm going to create these alerts, and I'm just going to look at this position once or twice a day at worst. So I'm sort of looking at it right around 8 o'clock Mountain Time, which is a half hour after the market opens. And then I'm trying to look at it also in the last hour or so if I can. Yeah. Yeah, so there was a post on my blog recently about trading for the bathroom. And that's sort of what I was, referring to. What I'm trying to do, I guess, with this position from a practical standpoint is to look at it in the morning before I go to work, or also, potentially the night before. And so I'll have an idea based on where the futures are trading if it's likely that I'm going to need to make an adjustment that day. So if we go back to that example of like we had the 1160 butterfly on and we added the 1180, what I might do is get up in the morning and I'll analyze that 1180 butterfly and I'll say, okay, this is probably about what I need to do if the market moves to whatever level. I'll then enter that butterfly as an order way, way away from the market. Like I'll enter it for a debit of 1 or something like that, And if somebody filled me on it, for a debit of 1, I'd be happy to own it at that price. It hasn't happened yet. And I'll do the same thing with the IWM call. I'll analyze that and I'll put it in for a nickel or something, to buy it for a nickel. And if I ever happen to get filled on it, I would take it. And if the market does move in that window of time, then I'll have those orders sitting in my phone and I can go in and cancel, replace them closer to the mid. That was sort of yeah, Bert does the same thing when he's at work. So one of the things that I think is really important is trading is a performance-based endeavor. And, the only way that we improve at performance-based endeavors is to understand what we've done and to understand what's working and what's not working and look for opportunities for improvement. And so I'm really big on this idea of tracking your position every single day in Excel. And the blog is sort of acts as like a trading journal for me, but I think also keeping a trading journal is an incredibly helpful habit to have. The amount of improvement that those two activities have given me is far beyond anything that I can imagine. One of the problems with simply using P&L as a measure of good and bad is that in many cases it doesn't take into consideration what the market has done, you know. So we trade these strategies that have a high probability of success, and just because we lose money on the trade or something, it doesn't mean necessarily that we traded the position bad or did something like that. It's just that we were in an unfavorable market environment. And so I don't like to lean too heavily on P&L as a measure of, you know, I'm doing good or bad. It's more a measure of, am I taking responsible risk, and, you know, am I keeping this within the guidelines of my trade? You know, if I'm saying my maximum risk is $300 and I'm letting it run to $700 or something and then come back on me and I make money, I think that's a bad measure of success. It's not sustainable and it's irresponsible. And at the same time, so this notion of consistency is something that people are really looking for a lot. You know, people want to be consistent in their trading and things, but I think that in a lot of cases we need to have more intention about what success looks like for us in trading. Some of this philosophical stuff I could talk about probably for a really long time, and it might take us a while. I just want to, I'll leave you with this, and then maybe we can take, you know, some of the last minute questions. I know, I'm not sure how long we have, but I've been talking for a while here.
So we can take a few more questions.
Okay, so these are some things that I do on a regular basis, and I realize some of this stuff is touchy-feely, and I'm definitely not the most touchy-feely guy out there, but I do really believe in the power of meditation and incantations. Incantations are sort of the process of saying, like, I, Dan, will be a consistently profitable butterfly trader. And I realize that sounds really cheesy, but surprisingly it works. And I think it works in a lot of ways because when we do that, we create this intention in our mind. And we believe that these things are true before they actually become true. And then we start acting out habits that cause those things to manifest themselves. So what Bruce Lee said is that consciousness of self is the greatest hindrance to the proper execution of all physical endeavors. And what he was talking about, I have not gone to peak potential events. And what he was talking about, I think, is that, you know, that concept of the flow state. And the only way that we ever achieve that concept of the flow state is through, you know, kind of deliberate practice and a constant focus on improvement, which is kind of this stuff, you know, the tracking and things like that. So that's about all I have. I think there are probably some additional questions out there. One thing I do want to point out is we walked through that example relatively fast. If you go out here to the blog, thetatrend.com, and go to, you know, this link or go to the category there for butterflies, you'll see that there are a few case studies of closed trades. And so you can kind of walk through the process of the different adjustments and see what's been done. And I think it's something that will be helpful to take it at a slower pace like that.
Well, great. Appreciate the nice presentation, Dan. We do have a couple more questions. Like, did you see Alex's about the black swan?
I missed the black swan question.
Oh, he said, since you're in the trade nearly 100% of the time, what's going to be your reaction and damage in the case of a black swan event, like a flash crash, but it doesn't come back?
Yeah. So what I do is in the base position. So when you have one rut butterfly and one IWM call on, so day one, the cost to get into that trade, let's just call it $1,200 to $1,300, something like that. That position, if you're risking, if you're taking that on a $10,000 account, represents, 12 to 13% of your account or something like that. And that's a size of risk that I'm comfortable with taking. Because I think those events, that kind of thing is just not going to happen all that often. I mean, they can certainly happen, but, I say, well, if I lose 10% of the account, that's just what happens. When I get up into the 2 to 3 butterflies, the risk starts creeping up. And so if you're sizing this based on a $10,000 account, you're starting to talk about 30 to 40% at risk. In that case, I'll buy a put or two down out of the money. I'll buy some unit puts. The nice thing is when you're in a 2 or 3 butterfly position, it usually means that the market's been raging higher and the price of those puts is relatively low and they're somewhat close to the money. So I look at it as total risk. If the market was to trade down 20%, and I do actually sort of think about that. What happens if we wake up tomorrow and the market's 20% lower? And if I feel comfortable with that level of risk, I don't do anything. If I'm uncomfortable with that level of risk, I'll buy some unit puts, 5 to 7 delta puts in the same expiration cycle as the trade.
Okay, and then Robert asked, he's tending to gravitate towards trying to combine trend following and income trading. Are you still working on those concepts?
I am. That's sort of my that's like one of my long-standing projects, is how do you combine trend following and options trading. I haven't had the time to devote to it lately that I would like, but I have all kinds of projects like that I work on periodically.
Let's see. Fred asked, per your definition, what's the expectancy of the strategy?
So I guess what I would say is let's say it wins 85% of the time in 300, and then 15% of the time it loses. And let's say we lose, even if you want to say it's really bad, say you lose 375. So you lost $300 and you had a bunch of commissions because you were adjusting it, something like that. For me, I get yeah, I mean, that gives the trade an expectancy of like 190-ish or something like that. It's in the, I would say it's in the mid to high 100s.
Yeah, pretty good. Let's see. A couple questions about, they're talking about the black swan. Jerry, let's see, where was it? It's what bothers Jerry about these types of trades with the zero line on the upside, the black swan type of events, 3 to 4 standard deviation moves. So I guess if you're worried about that, the long puts are your best friend when you add those units in.
Yeah, and I do think, look at the total risk of the position, relative to the size of your account when you're thinking about that too. And that's right. It's a personal preference thing. How much are you willing to give up?
And Ron asked about a special offer. There's a $10 discount for the Capital Discussions members on our member site. And that's available to anybody who's basically a gold member or has basically spent about $100 or more with Capital Discussions.
Yeah, and I just saw a question pop through from Jay about the trades overlapping, and I would say they overlap sometimes, but not by very much, maybe by a week or so. In a lot of cases, I'll even have a few days or a week where I'm out.
Okay, and then that's probably it for the questions. So we'll wrap this up. I'll get the recording put on a web page, and we'll send a link out to everybody. So don't worry if you came in late. You'll still be able to watch the whole thing. And thanks very much, Dan. Really appreciate taking the time and presenting your CIB trade. Lots of questions, so there's a lot of people interested in it. So great job. Yeah, thanks, Tom. I appreciate the invitation, and Jim as well. Thank you. Thanks. Okay, everyone. That'll do it. Have a great Saturday, and hopefully good trading next week for you. And a happy holiday season as Christmas is fast approaching. Oh, yeah. Happy holidays. Okay, and last thing, don't forget, if you're going to do any tax moves, you're running out of time for 2015. So. It's true. Okay, see you, everyone.